This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Back in the black, stocks rally more than 1%, pushing major averages into positive territory for 2015 as investors turn their attention now to tomorrow's employment report.
What a year it has been for General Motors CEO Mary Barra. After a recall-filled 2014, has GM changed for the better?
And the battle begins. The Republican-led House takes its first whack at the Affordable Care Act by attempting to change the definition of the work week. All that and more tonight on Nightly Business Report for Thursday, January 8th.
Good evening, everyone. I'm Sue Herrera. Wall Street rallied again today, the best day for stocks in 3 weeks. The major averages gained back all of the New Year's losses and more on hopes for more stimulus measures in the Eurozone and encouraging data here at home about jobs, just one day ahead of the December jobs report from the Labor Department. So here's how the markets looked at the closing bell. The Dow surging 323 points today, with all 30 Dow components making gains. The Nasdaq gained 85, and the S&P up by 36 points, with all 10 sectors ending higher.
More now on that good news about jobs. The Labor Department reporting that first-time jobless claims fell by 4,000 last week. They now hover near 14-year lows. And even though there were nearly 33,000 planned corporate layoffs in December, the outplacement firm Challenger Gray and Christmas says that overall 2014 had the fewest number of announced job cuts since 1997.
Well, the December employment report is due out tomorrow, and it's also expected to be strong. According to Dow Jones, economists expect to see job gains of about 240,000, and the unemployment rate is forecast to fall 0.1% to 5.7%. Stuart Hoffman, PNC Financial's chief economist, joins us now for a preview and some more details on what to expect in tomorrow's report. Good to see you again, Stuart. Welcome back.
Thank you. Good to see you, Sue.
Do those numbers, the expectations in general on Wall Street, do they match what you're looking for?
Yeah, they do. Hopefully that's not the jinx. We're looking for about 250,000 increase in payroll jobs. You know, November was over 300,000, but if you're getting 250,000, that's a strong report. It'll cap, 2014. We think when you add them all up, we got close to 2.8 million jobs all of last year. And yes, I agree, the unemployment rate likely to move down to 5.7. And buried within there, I think we'll see some good data on a lot of these jobs will be full-time jobs, not part-time jobs. And I think we'll see a little better wage boost, maybe not the 0.4 we saw in the month of November, but 2 or 3 showing there's some budding wage pressures or wage gains for middle America.
Is there anything on the horizon, Stuart, that could fly in the face of this good jobs momentum? Basically, what I'm asking is, what do you expect for 2015, the whole year?
Well, we're actually expecting a lot of good things. We've got economic growth of around 3.25% for GDP. We think we'll have jobs again this year at up close to 3 million. Think we'll end the year with the unemployment rate in the low 5s. So instead of a high 5, it'll be a low 5 for the unemployment rate. Yes, Europe is weak. That could be some of an offset to economic growth here. But I'm one that thinks that the drop in oil prices is a big net win for the U.S. economy. Of course, there are winners and losers, but I think it's a huge win for Main Street and pretty much a win for most of Wall Street.
You know, Stu, one of the issues in the employment reports recently has been the participation rate, that some people who haven't been able to find jobs simply fall off the list and are not counted, and the participation rate has been troubling. Do you see any improvement on the horizon in that part of the report?
Yeah, I do, Sue, and I think we've seen some. The rate is sort of leveled off here at just around 63%. Clearly that's down. There's a demographic of retirement that's likely to push that participation rate down for years to come. But in the last year or so, it's sort of stabilized after declining in 10, 11, 12, and 2013. So I'm expecting tomorrow the participation rate to hold steady at about 62.8%. And so we'll see that a drop in the unemployment rate is not because people are dropping out of the workforce, that they're actually getting jobs. And I also think the U6, the so-called underemployment rate, will fall as well. And that's a sign that Janet Yellen and the Fed watch as to how many of these jobs are full-time versus part-time. And all last year, and I think again in December, while I know there's a lot of talk about these are all part-time Mickey Mouse, Minnie Mouse, McDonald jobs, if you look at jobs in construction and manufacturing, business services, and then you look at the number breakdown between full and part-time, the jobs we created last year, and I think in December, are more full-time, better paying jobs.
All right, Stuart Hoffman with PNC Financial. Thanks so much for joining us tonight.
Thank you.
Well, one big growth area for jobs, the app economy. And today, Apple said that it helped create directly and indirectly more than 1 million U.S. jobs in the apps industry. Apple says that roughly 2/3 of those positions are developers creating programs exclusively for its iPhone, iPad, and iPod devices.
A bit of a different story, though, at two of the nation's most iconic consumer brands. With soda sales falling, Coca-Cola announced plans to cut upwards of 1,800 jobs around the globe, part of a $3 billion cost-cutting plan. And McDonald's is serving up pink slips to at least 63 employees at its corporate headquarters amid slumping burger sales.
Back to the markets now, where domestic crude prices ended higher for the second session in a row, but not by much. West Texas Intermediate up 14 cents a barrel. It settled at $48.79. But international Brent drifted lower. It is now below $51 a barrel. And the overall trend in lower oil prices is being felt by a number of businesses besides energy companies. Morgan Brennan has more on who else is getting squeezed.
The collapse in oil prices is beginning to take a toll on other industries. United States Steel Corporation is temporarily idling 2 factories and laying off roughly 750 workers, a direct result of crude's dramatic plunge. Supplying tubes and pipes to oil and gas drillers is a key market for steelmakers, and up until now has been a bright spot for the hard-hit industry. But with energy companies expected to slash capital spending by as much as 20% this year, that means less steel.
U.S. direct steel consumption into the energy market is about 10% of the market, but when you include energy-related infrastructure, that number bumps up to about 15%. So the weaker growth in oil and gas is really driving down the growth rates in U.S. steel consumption this year.
Factor in a stronger dollar and an oversupply expected to get worse, and 2015 doesn't look good for the commodity. But steel isn't alone. Other industrial companies are also beginning to feel oil's effects. General Electric recently said it expects revenue from its oil and gas segment to fall this year. GE's business, which makes compressors and drilling equipment, accounted for 12% of 2013's overall sales, with billions of dollars invested to expand that. And after a year of stellar growth, experts are watching railroad operators as well.
As we see the potential for these lower crude prices to persist for a period of time in 2015, you could see some production drops. You could see some of the volumes on the crude or the sand side come down.
However, Weatherby does note that oil and related fracking supplies make up only 1/10 of overall rail volumes. Analysts warn that Caterpillar, which is already laying off workers due to weakness in mining, could also come under pressure from its exposure to oil and gas. And Archer Daniels Midland may feel the pinch of cheaper ethanol, which is falling as export demand wanes. But for every company hurt by oil's downturn, many others are benefiting. Airline carriers realizing cheaper fuel costs, and retailers that could, at least in theory, see a boost as consumers spend more on things other than gasoline. For Nightly Business Report, I'm Morgan Brennan.
And speaking of gasoline prices, the topic is attracting attention on Capitol Hill. Republican Senator Orrin Hatch, the new chairman of the Senate Finance Committee, said today that he has a, quote, open mind when it comes to raising the gas tax to help pay for highway improvements. He calls it a user fee, and that people who use the highways ought to pay for them.
Honda now faces the largest civil penalty of its kind ever. The automaker has agreed to pay $70 million in fines to U.S. auto safety regulators for failing to report more than 1,700 death and injury claims related to crashes involving cars with faulty airbags. Millions of Hondas and other autos with those defective airbags made by Japan's Takata Corp were later recalled.
General Motors knows a thing or two about recalls, of course, after faulty ignition switches linked to more than 24 fatalities led to the recall of millions of autos and billions in costs last year. And that was all just in the first year for the new CEO, Mary Barra. Shares of General Motors over that year are down about 10%. So what's Ms. Barra's outlook for 2015? Phil LeBeau has that story.
For those of us who have dedicated our lives to this company, it is enormously painful to have our shortcomings laid out so vividly.
After a scandal-filled 2014 that included defending General Motors on Capitol Hill, CEO Mary Barra believes her company has changed for the better.
I hope you see that GM is what I feel moving in a very positive direction, and we're getting to the core with the right products, the right brands, and making the right decisions. And I think you know me well enough now, with all the time we had the opportunity to talk last year, that I'm a very results-oriented person. Getting by is not my idea of winning, and I also hate excuses.
Barra admits there's no excuse for GM waiting years to recall millions of defective vehicles. But despite a year of negative headlines, GM sales last year actually increased by more than 5%. And despite its market share edging to an all-time low, GM is still #1 in the U.S. Market watchers believe Barra has weathered the storm that rocked GM in 2014.
It does seem like she has made a lot of the right moves. It seems like she has shown that they still have a commitment to customers. They still want to do the right thing. She admitted her mistake, which is, I think, really big. I mean, companies have a hard time doing that.
Cheap gas and America's renewed love for trucks and SUVs helps General Motors, which has a strong lineup in those categories, and overall is selling vehicles at record high prices. As for the rest of this year, Barra expects industry sales to continue growing.
In the U.S., we expect continued steady growth in the industry, and we believe it's going to come in somewhere between 16.5 million and 17 million units. And, you know, if you had to say pinpoint it, probably right in the middle of that range.
The real test for 2015, can Mary Barra grow General Motors' bottom line? As Barra herself said today, profitable growth is one of her top priorities. Phil LeBeau, Nightly Business Report, Detroit.
Still ahead, the question many companies are asking in light of the attack on the satirical magazine in Paris and the cyber attack against Sony Pictures. What should be done in the face of intimidation? Some mixed messages today about the state of some well-known retailers before today's opening bell. American Eagle, Aeropostale, Stage Stores, Cato, and the team retailer Zumiez all raised their guidance for the just completed quarter. And others like JCPenney, Pier 1, and Barnes & Noble reported higher holiday sales. But after the bell, not so good. Bed Bath & Beyond, the Container Store, Five Below, and the Gap all reported lower than expected revenues. And Macy's announced restructuring plans, which includes closing down 14 department stores.
A breakthrough drug to treat one of the deadliest types of cancer may be closer to getting regulatory approval. Pfizer has begun talks with the FDA to finalize details of the prescription label for its breast cancer drug palbociclib, or Palbo for short. A decision from the FDA is expected by mid-April.
And some U.S. scientists have discovered a powerful new antibiotic in an unlikely place, which is being called a game changer for overcoming resistance to existing drugs. The new class of potent antibiotics, called Teixobactin, was uncovered after screening 10,000 bacterial strains found in dirt. The new antibiotics have already been used to kill an array of germs without becoming resistant to them.
Well, all of these advances are indicative of the banner year that 2014 was for the biotech industry. And with a huge annual healthcare conference kicking off this Monday, Meg Terrell gives us a preview of what's ahead this year in biotech.
After the year biotech's had, all investors are asking the same question. Can it do it again? Excitement over medical advances and strong sales of new drugs helped biotech outperform the broader market for the 5th year in a row in 2014. Next week, the biggest industry event of the year will set the stage for 2015, the JP Morgan Healthcare Conference in San Francisco.
Maybe the most important healthcare conference in investment banking. Certainly, it's the first one of the year. It sort of sets the stage for the rest of the year. It sets expectations, at least for the first half of the year, in terms of the companies. And it also gives us a sense of sentiment.
More than 400 companies will present to thousands of attendees at a summit that's been referred to as the Woodstock of healthcare. The industry's been on a tear on all fronts. The NASDAQ Biotech Index rose 37% in 2014 versus 15% for the S&P 500. Initial public offerings hit record levels, and an acquisition frenzy from Pfizer to Merck to Actavis contributed to rising valuations. So what could burst biotech's bubble? Investor Les Funtleiter points to two main issues.
There's the looming potential price war. We saw some evidence of that with Gilead and AbbVie at the end of last year. There'll be some discussion of are there other drugs and drug classes at risk of that. And there's also the ever-present concern over the Supreme Court and Obamacare.
The J.P. Morgan conference can be a big newsmaker, propelling shares of many volatile healthcare stocks. Companies release clinical trial data, provide forecasts, or announce deals at the summit. RBC Capital Markets analyst Michael Yee says Celgene and Vertex are two important stocks to watch.
I think there's going to be a lot of wealth of data on a bunch of SMID caps as well. But I think that we come out of the conference with a bullish view, and biotech stocks are trading up on that.
We'll let you know next week. For Nightly Business Report, I'm Meg Terrell.
Biogen IDEC announced hopeful results in a study of one of its most watched experimental drugs, and that is where we begin tonight's market focus. The therapy showed promise of being able to repair optic nerve damage in some patients in a mid-stage study, and the results hint that the treatment could help those suffering from multiple sclerosis, which could be a multi-billion-dollar opportunity for the drug maker. But some analysts said the results lacked clarity. Shares fell 1% to $349.32. The wholesale retailer Costco saw its same-store sales rise by 3% in December, and that was better than Wall Street was looking for. And since the positive results were from the all-important holiday shopping period, the stock was higher. It rose a fraction to $145.56. Opposite story, though, for Family Dollar. In the company's earnings report out today, it announced that its fiscal first quarter profit was weaker than expected. This as it stepped up discounting and booked more sales of lower margin items. Shares there fell slightly to $78.51.
Strong sales of Corona and Modelo beers helped Constellation Brands top earnings and sales estimates. The beverage maker raised its full-year earnings forecast as well. Shares were 4% higher to $107.64. Hedge fund Starboard Value renewed pressure on Yahoo to buy AOL, sending shares of both companies higher. In a letter to Yahoo's CEO, Starboard's chief repeated that it should explore a combination to cut costs and to improve its profits. Yahoo rose by more than 3%. AOL was up by 7.5%. And shares of Ford rose after the automaker hiked its quarterly dividend by 20%. The payout is now 15 cents a share, and it will be payable at the end of the month. That lifted the shares up 2.5% to $15.42.
Yesterday's terror attack in Paris on the satirical magazine Charlie Hebdo came after years of threats against the publisher and even a firebombing of its offices. Although the assault was unusual in its deadly brutality, it is not uncommon for businesses large and small to be the target of threat or intimidation. The Sony hacking story is another recent example. So what can and what should businesses do in the face of intimidation? Richard Torrenzano is CEO of the risk management firm, the Torrenzano Group. Richard, welcome. Good to have you with us.
Nice to see you both.
You know, I think of these two most recent incidents, one deadly, one highly disruptive. What unites them is that they were perpetrated by individuals or countries that had a beef against those specific companies. These were clear threats of intimidation. Do you expect to see more of this happening around the world and even here in the United States?
Well, we don't. No one really knows, but I think you have to speculate and you have to give it your best thinking, and that's what I think a lot of companies are doing right now. We've had more calls in the last 4 weeks since the Sony attack than we've had in the last year on this subject. Matter of fact, I had to postpone. I know you had to postpone an Italian vacation. I had to postpone a Caribbean vacation because of that. You need to look at the world in three pockets right now, and I'm generalizing here a bit, but the Chinese are stealing our secrets, our proprietary information. The Russians are stealing our financial data, and the Middle East have assassins. Now, this is not all the people in those countries, clearly, but that's generally how the risk world is looking at the world right now. This is far more than intimidation. And this is, if you take a step back and look historically at the world, you and I have talked about the Red Brigade in the 60s and 70s and how they attacked business people. You have to, if you're in a corporation, whether you're the CEO or the CFO or the COO or in HR or in marketing or in communications, you have to sit back and look at your industry and look at your geography and say, look outside the box and say, what can happen here? One of the calls we're getting is they want an outsider's perspective because you have some very smart people in these positions in corporations around the world.
Do you find that American corporations, especially those with a global footprint, are prepared enough, or how far behind are most major corporations in looking at their safety, their infrastructure, their cyber security?
I think some are prepared and some are not prepared. I think the ones who have a more global view about what's really been taking place in the world. The multinationals tend to look at these things, whether you're in security or IT or wherever you are, and look at a global view and say, what do we need to do in this new environment? I mean, the calls we've been getting came out of Sony and now the last 24 hours because of Paris. I think you have to take a hard look and say, could this happen here? And are we prepared? Are we protecting our employees the best way we can? Are our facilities secure the best way they can be secure? How are we looking at IT, computers and websites?
I guess you have to think also about your vulnerabilities. Pharmaceutical companies that do animal testing, they can be vulnerable to animal rights activists who have a problem with that. Other companies may have vulnerabilities of intimidation because of a stance they may take on a political topic, whether it's gay marriage or something else.
If you look at the radar and you look at what's been happening in the world, whether it's shareholder activism or anti-police activism, or unfortunately the terror tests in Paris or the Sony attacks and others, a lot of lights are lighting up. There seems to be an attack against a democratic way of life. One of the great things I saw in reading the French papers this morning was the way the French people responded, do not steal our freedom of speech. I mean, going back to our American Revolution, the French gave us the idea of freedom of speech. But I think there is an attack against institutions in a way we haven't seen them before, and I think, I hate to say it could accelerate, but it can, and all you need to do is really have a plan and be prepared and be thinking about it.
Richard, we have to leave it there, a topic I know we'll be returning to. Richard Torrenzano of the Torrenzano Group.
As we continue, coming up, how long is a work week when it comes to health care coverage? 30 hours or maybe 40 hours? Well, that question is being debated on Capitol Hill, and the answer could have major implications for business. Americans are borrowing more money these days, the most, in fact, ever. U.S. consumers increased their borrowing in November as higher demand for auto and student loans offset a drop in credit card use. Overall, borrowing rose by another $14 billion in November from the month before to a staggering $3.3 trillion.
And finally tonight, the House of Representatives today voted on a measure that changes the definition of full-time work, a full-time work week, that is, when it comes to health care coverage. Hampton Pearson takes a look at the first big battle of the new Congress.
A challenge to the employer mandate triggered the first clash in the new Congress over the future of the Affordable Care Act. Republicans introduced legislation changing the definition of a full-time work week from 30 to 40 hours per week, claiming it will save jobs. This is the first year the employer mandate takes effect. Under the current 30-hour work week standard, employers with 50 or more workers must offer health insurance or face fines of $2,000 to $3,000 per employee.
So guess what's happening? Businesses are cutting workers' hours. They're keeping them below 30 hours to avoid the penalty. It's commonly known as the Obamacare 29ers.
Democrats argued raising the mandate trigger to 40 hours opens the door for businesses to walk away from their obligation to offer employer-based health care.
This bill says this is the blueprint for business to shift all their employees onto the government. Very simply, close the building at 4 o'clock. Now everybody's only worked 39 hours, right? Go home.
Small businesses, particularly fast food restaurant chains like White Castle, say the actual increase in healthcare costs makes cutting hours a necessity.
So for us, what we were facing without changes to scheduling was a 35% increase in our healthcare costs if we didn't modify in some way. So we've had to take a surgeon's precision to our scheduling.
But even some pro-business conservatives say this particular cure could be worse than the disease. Analysis of data from the Small Business Administration finds about 29 million employees at large firms work at least 40 hours a week, while only about 7 million work 39 hours or less. A 40-hour threshold puts 4 times as many people at risk of having their hours cut and losing their health insurance.
A better approach would be for Congress to cut the employer mandate entirely.
The bill is now headed for the Senate, where Republicans have work to do. Lobbyists supporting the bill say they don't yet have the 60 votes needed to bring the measure to the floor. And the White House has served notice that the president will veto any legislation that changes the current standard. For Nightly Business Report, I'm Hampton Pearson in Washington.
That's going to be an interesting fight to watch, I think.
It sure is, as so many will be.
Absolutely. All right, that's it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks for watching.
And thanks from me as well. I'm Tyler Matheson. We'll see you back here tomorrow.